what I'm happy to share with all of you is that we've been able to grow our business within the same business we have been already created by ensuring that we automate the majority of our services, we digitize services, but we will create a value chain of our customer. And we have been able to create more value within our business. On the growing the business, there's been an area where the bank has possibly never put in much efforts, but with digital accelerations, we have been able to acquire new businesses through digitizations. And this is purely on the unbanked perspective. I mentioned about CRDB Foundations, which is purely on the financial literacy, but focusing purely on the special group, women and youth. And we have been able to create a substantial business in that area. But the other segment which we have been looking at is on the partnership, to leverage on the partnership of our members and use the same channels to give services. I think what we see currently, there are some of the segments where we have seen a growth, especially on agri, as well as on the side of value chain. And I believe that will obviously keep CRDB growing activation. On the future proof, what I'm happy to share with you, we are currently actually strengthening our digital channel, but also the system in terms of technology advancement. We are moving to the new core banking systems that will give us a much more robust services. We have also deployed robust infrastructure to ensure that we are able to innovate as much as quickly through the ESB. And that has given us edge on automating majority of our services. But nevertheless, we have also strengthened our partnership with the global partners to ensure that CRDB remains strong in terms of funding, co-financing, capacity building, liquidity management, as well as technology advancement. I think the other area which is also important is to share with you that despite all those what I've just highlighted, I think what we are happy with in terms of economic wings, I think Tanzania remains to be stable, and there is a much political will to continue changing those policies which are challenging. And I think we have also recently seen that the government is engaging private sectors to review some of the policies that will make not only the finance sector, but more private sector to accelerate, and that obviously gives CRDB an edge. Key important element of this one that even our subsidiary in Burundi, there's been a lot of changes in Burundi, which has also enabled the environment in Burundi to be robust, and CRDB as we speak currently in Burundi is number one. This is one of the great changes which is also important. However, as we continue deploying those new regulations, CRDB remain cautious to ensure that we remain stable on what we are offering. In terms of what are the fundamental pillars which has enabled us to achieve the result, but also what we see as we move forward to the half of the year. One is ensure that our strategy, which is in operations, is executed well. Secondly, is to ensure that the bank remains efficient and vigilant. And the third one is to ensure that we are working with key partners to strengthen our operations. But more importantly, is to ensure that we keep changing and create good behavior and culture that enables CRDB to remain fit for growth. And that's what we have been doing. One of the programs is to ensure that our staff are empowered, enabled, but their resilience to sustain, to compete. And one of the strategies we started, I think, a couple of years ago, was to make sure that within the workforce of 4,000, we should have at least only 30% the back office, and the rest must be front office. And we have seen the result of that particular initiative. Secondly, is to ensure that our service are improved, but more or less automated. And I think you will see the results how much we have achieved through automations, and that has created much improvement. Third is to continue with innovations, and one of the key innovation indicator which is currently picking the market is what we call embedding and supporting startups. This is one of the key areas which has also created a mass and underserved segments, and where CRDB is taking a lead. And nevertheless, there are key segments which we are focusing, and I think I highlighted. This is what we call SME, MSME, micro and SME. The bank, I think you have seen our portfolio. It's quite, of course, we have a good position for corporate, but our focus is on the SME. But we understand we can be able to do better, support the segment better, as long as we are able to create a channel that will provide the capacity building and the financial literacy. Ensure that we transform them from informal to formal. And that is the key for the success of our business. And what we have seen, majority of the segment is performing well, and I think you will see our numbers when CFO is highlighting on that area. Digital will remain the key. I think that is the key fundamental, and that we can see from our cost to income ratio. It is because of digitizations and automation of our processes. Nevertheless, it cannot be achieved, all this which I'm highlighting, without having a proper oversight and the governance. I'm happy that we have a strong governance in place, both from board level as well as the management, and ensure that the business is run to a proper way. But I think what I would want to highlight to the group, that one of the key elements is to ensure that we manage enterprise risk management. And I think if you look where CRDB is coming from, in terms of asset quality, in terms of growing portfolio, risk is a key fundamental. And I'm happy that on the credit side, through digitizations, we have created many tools that gives us early warning signals of the portfolio management. It also gives us which credit facilities we need to focus on, but also share with our customer on how they should be able to conduct their business. And that has been able to support our success so far. Key segment, I think we continue to oversee, and I would like to highlight, apart from the agri and SME, is to focus on key projects in terms of supporting government infrastructure. And on this area, we are actually at CRD, we move us on the value chain perspective, because our focus is SME, and the majority of these suppliers, we provide solutions for them. In terms of our efficiency and operations, from the slide which is being highlighted, our current operations, about 87%, are digital transactions. Our branch network currently is only performing about 3%. This is a great achievement. And that's why you will see some of our non-interest income, it will start growing because of what I've just highlighted after completion of our key projects. When you look on the products which we have issued, I mentioned about insurance. Insurance is one of the key company we have established. At CRDB, as institutions, we serve customers, and that's where we have defined insurance from general as well as bank assurance. And that is growing to the expected, but we see much potential business as we move forward. Our Sharia, Islamic banking, is taking a pace, and it's actually one of the key areas where we see a growth of deposit. And we are looking forward as we move forward for the scoop, which will be coming up toward year end. I may not go through each slide. I think I would like to wind on the other area, which is on the project financing and asset financing. These are the pure project which we created for contractors, which is one of the biggest segment in Tanzania. And it is also a good area for deposit mobilizations. And those initiatives is what has given us the result you see today. But also there is a quite promising in terms of what we see going forward for the half of the year. I hope and looking forward to achieve a better results. So given the time, I would like to allow our CFO to speak on numbers.
Thank you, MD, and thank you everyone for joining. I'm happy to share the financial performance of the bank for the half year of 2024. Strong performance as highlighted in this slide. We recorded profit after tax of 23% year-on-year growth to Tanzanian shillings 275 billion. This is mainly, as you'd see in the next slide, driven on the back of a number of factors as highlighted in terms of the areas that are mainly driven the key strategic implementation, but mainly backed up by the top line growth and the non-funded income growth. Total asset grew by 19% on year-to-year, closing at 14.9 trillion, backed up with the 24% growth on year-to-year on the loan portfolio to 9.5 trillion. We closed with the customer deposit at 10.1 trillion with a year-to-year growth of 15%. Our NPL closed at 3.2, mainly on the back of the strategic initiative in terms of migration containment. Return on equity closed at 29%, and our cost-to-income ratio recorded an improvement to 45% as we close the quarter. As I highlighted, strong balance sheet growth, mainly driven by a growth in the loan book, 24% on year-to-year. Diversified portfolio, as you will see in the next slide. Mainly the growth contributed by the growth on consumer lending, corporate lending, and in corporate lending specifically, our growth in agriculture is contributing on the growth that you are seeing. But on retail, you will note we recorded a notable growth on our key area of focus, the SME and the MSCs. Our total deposit, as highlighted, grew by 15%, mainly contributed by an increase on the core deposit, savings deposit, and the demand deposits. So in terms of the loan split, we could see mainly the loan book is contributed by a significant amount on retail segment, which is at 53% compared to corporate at 47%. Mainly the key sector where we see the biggest contribution is consumer lending at 36%, agri, as I highlighted, 19%, and the trade at 13%. We closed again with our NPL at 3.2, but just to highlight on the split in the balance on our own portfolio, our loan book in terms of the current split, the forex loan in total loan book decreased to 26% compared to what we reported in the previous quarter. So going to the portfolio quality, our NPL closed at 3.2, mainly contributed by the three sectors I highlighted: agriculture, which is forming about 36%, trade 28%, and the consumer lending 16%. And when you go to the key segments, corporate continue to contribute the high portion of our NPL at 64% compared to the retail, which is 36%. In terms of the deposit, as highlighted, the growth in our deposit mainly is coming on the key areas where is core deposit, the savings deposit, and demand deposit. But as we close the quarter, our CASA closed at 82%. Just on the currency mix, again, you could note from the previous quarter where we reported 17%, the deposit composition in terms of the forex to local currency stands at 20%, an improvement of about 3%. Again, when you look at the composition of our deposit in terms of the split corporate retail, 61% is coming from retail, and 39% is coming from the corporate segment. So in terms of the liquidity, we closed with a strong liquidity position at 27%, well above the regulatory liquidity requirement of 20%, mainly contributed by strong funding source from the deposit at 69%, compared to 71%, diluted by an increase on the borrowing, which is 18% of the total funding source. In terms of the P&L, as highlighted, we recorded a very strong performance, closing with the 274.9 billion PAT, with a growth of 53% on year-to-year, mainly contributed by the growth on the top line, where we recorded a growth of 29% on the interest income. And the net interest income grew by 35%, mainly contributed by our strategic initiative to align our pricing on the portfolio and the portfolio mix in line with the market movement. But again, the containment in terms of the funding cost, which grew by 16%. Our NIM improved to 8.6, as you could reflect from the last communication. Our NIM stood at similar quarter last year at 7.9. We are happy to report that our strategic initiative in terms of aligning our pricing, the aligning of the portfolio mix, but again, containment of the funding cost is paying results, and you could see the improvement on our NIM on quarter to quarter, which is stood at 8.6. As highlighted, the biggest contribution of our profit after tax is coming from the non-funded income, with main contribution on forex, which grew by 17%, fees and commission 24%, and the other income at 34%. But notable contribution is on the fees and the commission, which contributes 70%. And as highlighted in the previous slide by MD, our investment on our digital touch points, the enhancement that we have been doing on our core banking system is now yielding the result. We see more volumes coming from our digital touch points. Our alternative channel contributes 56% of our non-funded income, mainly driven by SIM banking, which is contributing around 53%, and agents banking, the two being the key driver. You could see the growth on the SIM banking income growing at around 31%, agents banking growing at around 22%. Our cost-to-income ratio was closed at 45%, and as highlighted in the previous slides by MD, you could see our strategic initiative in terms of the digital adoption, the automation, and the review of our processes are now starting to yield the results. The decrease on our cost-to-income ratio from 46 to 45, and we are confident that we should see this one coming down as we continue to complete our mission-critical core banking system implementation, and which is a key driver on our digital adoption. Our subsidiary continue to post a positive contribution on the group profit after tax, contributing around 5% of the group profit. Notable contribution from Burundi with a year-to-year growth of profit of 78%, closing with a profit after tax of 18.1. Congo and the insurance, which are our new subsidiary, continue to perform well. They have not broken even, but we are confident they should be able to break even as per the plan. We continued to maintain a strong capital position, well above the regulatory capital requirement at 14.4 Tier 1, 15.8 Tier 2. We have started the implementation of Basel II, and we are confident we should be able to maintain the regulatory capital requirement in line with the regulation requirement. We have continued to engage with the central bank in terms of the implementation and the parallel line. We see no significant change on the adoption of the full Basel II, Basel III, and we keep you updated in terms of the progress. So in terms of the stock performance, great performance. Our stock, as we are closing the quarter, closed at 520, with the 520 shillings per share, with a market capitalization of 1.358 trillion, which again is a very positive year-on-year growth at 10.6. We are confident that we should be able to see more positive trend. As yesterday, the highest closed at 630, and thanks to the investors community for the confidence they have actually shown on our stock performance. I would just highlight on the outlook, which is the last slide before I stop and hand over back to the CEO. In terms of the outlook, there is no significant change on what we communicated in the previous communication. We are looking at a loan portfolio growth 15 to 18% from the 24% you are seeing as we are closing the quarter. Deposit growth, we are looking at 16 to 25% from the 15, an improvement in terms of our deposit growth as we close the second half of the year. The non-funded income, again, we look at around 35 to 40, again, a very positive outlook. The cost-to-income ratio in a range of 43 to 47 from the 45 that you are seeing today. And then our return on equity from 28, we are seeing it on a range of 25 to 30% with the positive outlook in terms of the positive trend. Return on equity, 4.5 to 6.5, and our NPL will remain within the range that we had communicated in the previous call. I will stop here and request to hand over back to the MD.
Thank you.
Thank you very much.
I think Thank you. Just on this second half of the year, I think the focus will basically continue to be on more of driving efficiency through automation and digitizations, but also innovating on the key new opportunities. And as I highlighted that we are currently running an insurance company, equally running foundations, which is acquisition channel. And the majority of these services will be actually offered through digital to support the group operations. We also looking on the new opportunities. The second element, which is key, as also highlighted, the key segment, which is our focus and remain to be our focus. One will be MSME, because that's where the bank would like to be seen as strong. Also, an agribusiness. It's one of the key area which I think for now, the way we are designing agribusiness is more of a structured way of doing it, not organic, not general, but more specific and customized. We also focus on the women and youth empowerment without forgetting about driving the more of a green and environmental with our project of the Green Climate Fund, because this is going to be launched this coming 2 days, where we'll be focusing on agri, looking after about 1.2 million customers, direct beneficiaries, with indirect beneficiary of about 4.9 million customers. The project is 5 years. I believe it will give us much more age to support the operations. And lastly, as we continue growing, risk remain our key focus. We continue to improve our portfolio diversifications, but also improve our portfolio quality to ensure that we have proper coverage ratio. And we have also NPL as projected with the current status which we have, even though it looks good, but I think we have ambition to keep it lower. But also look on the entire enterprise risk management, while empowering our staff in terms of skill set, but also accelerating our partnership as a key pillars to deliver our business. Thank you for that, and I'll be happy to share it back to Professor for Q&A and any other observations.
Thank you very much, Abdulmajid. That was a fantastic presentation. Let me start off by actually acknowledging the great results that has been produced by CRDB in the first half of the year 2024. I think the numbers speak for themselves. Net profits up 53% at 275 billion. Cost to income ratio have come down to about 45%. I think this must be a record low for CRDB. NPLs are well contained at 3.2%. The ROE at 28%. I think this is a fantastic set of results. So I do acknowledge that and congratulate the management team. Abdulmajid, Fred, the deputy MDs, all the department heads who are there, without forgetting Anna Mwasha. I mean, Anna, you've contributed, I'm sure. You have to have your credit also. But thank you very much. I think this has been fantastic. I'll kick off the questions just by asking the general struggles of banking in Tanzania and CRDB particularly on two particular challenges: the Forex challenge and the liquidity challenge. On the Forex challenge, I just wanted to know how CRDB is navigating with SBOOK having significant component of dollar borrowings, dollar lending, demand, trade financing demand, also deposits in dollars and other currencies, how the FX challenges are affecting CRDB. And the second one was on the funding side. The whole banking system is talking about challenges in terms of liquidity, and we can see some of that in tightening of liquidity in the market and changes in interest rates that we are seeing. So how is CRDB navigating those two challenges?
Thank you. Thank you very much. I will start with the last one in terms of liquidity. I think, yes, there has been a challenge on liquidity, and I think what we have seen for the second quarter especially toward the fourth year end of the government, there has been slowdown in terms of paying on key suppliers, and that also has created some challenges on liquidity. However, for CRDB, I think what I've just highlighted, we deployed a robust value chain solutions, and we have actually moved from looking for one customer rather than 360-degree, and that has given us much more edge of what you call follow the money. And you can see from the numbers, at least our liquidity, despite of the challenge, deposit has also grown. However, apart from the challenge we see on short-term liquidity, we are also having long-term liquidity. With the current partnership we have established with our key global partners, we have been able to raise long-term deposits for long-term funding, and that has given us some edge to navigate toward the operations. What we see as going forward, I think this quarter, next quarter might be okay because the government is expecting to start paying most of the supplier in the middle of this month and towards September. And that means, and this is maybe the first time, I think last year it was a bigger challenge than this. This time, I think we had a good strategy which deployed around the branch network, where we conducted a quite good campaign for deposit mobilizations. Nevertheless, the challenge of bond in terms of raising interest rate remain a challenge, and I believe that we have our product not structured as a bond, but it gives us aid to maintain our deposit without losing much of our deposit. For the forex, I will ask my colleague here to give you a more highlight. Yes.
I would take up on the forex, and then Maji would come in. But when you look at our strategic initiative to address the forex mix, you realize last year when we are communicating, the same time our forex portfolio mix was at around 30%. The great news is you see the mix is to date at 26%. We continue to decrease the mix in terms of the forex to local currency. But again, in terms of the funding, as Maji would highlight again, we focused on the long-term funding source, which is actually addressing the gap in terms of the forex. Our local currency again improved. When you look at the deposit mix in terms of the forex to local, the forex is now at 20% compared to 17% in the last quarter. So great improvement. We understand the market challenge, but we have been able to implement strategic initiative towards significant improvement. I would hand over back to Maji to just add on this.
Okay. So Joseph Maji is our head of asset and liability management. Karibu, Joseph.
Thank you very much. I think on the question that you have responded on FX challenge, I think is a global challenge that you have experienced. But you asked about how CRDB has been able to navigate and go around these challenges. Yes, we appreciate there is a challenge from the macro space, but from the Tanzanian side, I think the economy, if you look at the global economy, is highly diversified, and CRDB being the large player in Tanzanian economy has got an advantage of getting a bigger outlook than the other small players. So in that positioning, we have been able to assess the key demands in the market, and we have tried not to shy away from the supporting of our customer needs. So all the time, we have been supporting our customers, I think mainly to support the trade finance, which is a highly bigger business, which creates a huge demand in Tanzania. We have been opening LCs and some sort of importation so as to keep the economy rolling. So what the sacrifice we have done to ensure our customers being able to pay, we have cut our margin. So in the period of turbulence, we did not focus on the margin, but we focused on staying in business by ensuring all the LCs that are open for our customers, especially for the importation of the key commodities, have been managed. So the sacrifice we made in the time, we traded, increased our trade volumes in the FX side, but on the expense of supporting large volumes, and all our customers have been able to get sufficient, the available Forex reserve that was available for the country. So we know that the country reserve is covering 4 months of average, but all key commodities in the country, especially oil, food, has been able to be maintained. On top of that, CRDB has already been positioned. We know that another source of flows into the country is coming from the export of agriculture commodities. So CRDB took a decisive measure to ensure that all these export proceeds, especially the agriculture side, we have financed them. And when they receive the export proceeds, they come through our bank network, and those proceeds have been able to normalize some of the exposure that our customers are facing. But otherwise, that is the position that the bankers took to support the customers and to support the economy, key sectors, which bring FX proceeds. And as a result, we have been able to utilize these proceeds to meet the demand. This, we still appreciate there's a challenge, but we are rationing it in those measures that I've just highlighted. Thank you.
Yeah, thank you very much. I think that's very well noted. The challenge seems to be general. So let me open up for questions. For those of you who have a question, please write it in the chat or ask to be recognized for the question. I think I'll recognize Tim from Africa Alliance Fund to raise up the first question.
Yes, can you hear me?
Yes.
Yeah, can you?
I was just curious, you guys did just touch on it in response to Prof's question regarding the funding environment, but your increase in funding cost, I think, came to just 16% for the period versus the prior period, which is quite impressive compared to some of the other players in the market. So is that purely as a result of the long-term deposit financing that you have been able to source? Are you able to give a little bit more color on how you were able to restrict the increase in funding cost? Thanks very much.
Just to respond to that, as highlighted, you realize the containment of the escalating funding cost, which was maintained at 16%, is coming from the strategic initiative that we had communicated previously. We moved from fast short-term funding to long-term funding, which is relatively low cost. And again, that has played a bigger role. But when you look at the deposit growth, 15%, again, plays a key role in terms of what you see. But most important is, where do we source these deposits? You realize some of the deposit growth mainly driven from our ability to reach the markets, which most of the players are not actually there. Our agents banking is playing a key role. Our branch network is playing a key role. But the reinforcing of the value chain, we make sure we follow the money. For whoever customer we have in our portfolio, we make sure we are able to reinforce its entire value chain. So that strategy has worked, and we believe you should see more of the containment in terms of the funding cost, despite of the escalating interest rates in the market.
Thank you very much, Fred. That, I think, gives us some flavor on the funding cost side. I'd like to invite Muammar to take up the questions. Muammar, welcome.
Thank you, Prof. And congratulations to the CRDB team on a fantastic set of results. I just had a couple of questions around your asset quality and your capital adequacy. So just to start on the asset quality, the coverage ratio, the current coverage ratio has dropped to a multi-year low. It's now below 40%. If you could just maybe give us a bit more color on why it's so low and maybe where the management would like it to be. And just following up on that, I think from the last investor call that we had, Mr. Nshekanabo, you had mentioned that there was one name in the agricultural segment that you expected to upgrade in the first quarter or the first half of this year, and that would ideally improve the coverage ratio. So is the coverage ratio low because that hasn't happened yet? Do you still expect to make this upgrade? And then on your NPL ratio, I can see it's relatively low to where it's been in the last couple of years, but I just wanted to also ask, I mean, the contribution from agriculture and trade specifically seem to have increased. So credits at 36%, trades at 28%. Would you say your credit risk appetite in these two particular segments is relatively higher than some of the other segments where you underwrite credit like personal or manufacturing? Have you restructured any loans in these two segments? And what would you say is the outlook for growth in those two segments in particular? And my last question on your capital adequacy ratio. So your total CAR is at 15.4% versus a minimum of 14.5%, which gives you roughly 140 bips buffer. It's a bit low considering CRDB's systemic importance. Maybe if you could just share your personal view on what you think about that particular buffer, and in addition to that, maybe just give us a split of the total CAR ratio between the Tanzanian subsidiary, the Burundi subsidiary, as well as your DRC subsidiary. Thank you.
Thank you, Muammar, for this. I would start with the coverage ratio first. As we communicated in the last call, our coverage ratio is mainly affected by four corporate cases. Actually, initially, when we communicated last quarter, the biggest two, and the mostly one, which is in agriculture. According to the regulation, once the customer is in the non-performing loans, you have a cooling period, which is he has to stay there and show improvement in the 4 consecutive quarters. So we are on the cooling period, but again, some more engagement to make sure that we have that portfolio completely cured as it graduates from the non-performing. And if we excluded a 4, you would see our coverage ratio in the range of 65 to 70%. As we are communicating in the previous engagement, we look at having our coverage ratio above 70%. And if we exclude these 4 corporate customers who've slipped into the non-performing loans, and they are under the curing and the close watch to make sure that they are able to migrate back to the non-performing, you should see our coverage ratio back to where it used to be, in the range of 65 to 70%, and far better. So that, I think, responds on the coverage ratio. In terms of the asset quality, on the contribution on agri sector. Again, when you look at what I've mentioned, the customer specifically who slipped into the non-performing loan is in the agri sector. And that's why you see the contribution of the non-performing loan is mainly dragged by the agri. But if you remove that specific customer, the contribution in that sector would significantly decrease. And that is actually explained with the initiative we had previously explained. You see, we changed our lending modality in terms of the agri business. Again, when you look at the exposures in agri, mostly the corporate adequately covered. When you look at some of the small and individual agri business players, they are using the collateral which is backed up by the crops that they are put in the CMA. So, so to say, yes, you would see the risk being on high side. But when you look at the model that we deployed from the historical trend, we have the right mitigation from the origination, the monitoring and the supervision, and even the system of tracking. Again, you realize the NPL trend and the coverage ratio in this, the provisioning is again dragged by the historical cost, the historical trend. When you come to assess the ECL, you have to consider the historical trend again, which informs the risk level of this particular portfolio. But generally, the NPL level is dragged by the corporate customers that have slipped in this NPL status, which we are working out.
Just to add on the what CFO has highlighted, for agri customers, they are more of structured financing and the contractual based. Their current payment has been delayed because they're yet to be paid by respective ministry. And once they are paid, they should be able to recruit their facilities. For the customer you have highlighted, which was meant to be dropped from the last quarter, it is still in the same category because the negotiation discussions have just been completed and they have not concluded in terms of closure of the deal. What we are looking forward with this quarter, we should be seeing this customer out of this category, and that will be becoming to normal. I think the other customer which is also affecting the coverage ratio is pure on the regulation perspective. It was actually, it's one of the industry factors which we financed, and they just started operations. And since regulation required to keep them for at least 3 quarters consecutive, that's why you see it on that category. But the customer is still performing. So I don't see any challenge with that. Maybe CFO, you can cover on the capital side.
On the capital side, the subsidiary contribution of the capital, when you look at the sole capital position, there are no significant difference between the solo and the consolidated, because yes, in terms of the capital consumption, when you look at the subsidiary, still they are far much better in terms of their capital adequacy ratio on their own. But when we consolidate, because there are consolidation entries in terms of what the parent has invested on the subsidiary, and then the consolidated risk weight. But looking at their risk weight portfolio is relatively lower, and therefore the capital consumption from the risk weighted is still low. The only impact is the capital investment in the subsidiary that accounts in the risk weighted assets.
Yeah, just to highlight on the what measure we take, I think on the capital stabilizations, we have strengthened our syndication desk basically, and you will see much of our portfolio growing, but on the syndication framework. We are also taking course of the de-risking of our portfolio through our current partnership we have already established with our key global partners, because the arrangement is in place, and now we actually reviewing our portfolio to try to balance the risk-weighted assets, and basically we see our capital stabilizing to the position which it used to be, and ready, and even making the bank even stronger. And as also highlighted, the growth of our portfolio is focusing on the SME and MSE, and of course agri, as I think you have just asked the questions, remain to be our key focus segments. But the structure in terms of funding financing arrangement is more segmented, customized on a specific project. It's not generic. And that means we have actually put in place all the tools to manage the risk potential risk or inherent risk that may occur. And I believe with those measures, you should see our capital stabilizing back to the strength level. Thank you.
Thank you very much, Abdulmajid. I think the next question is a standard one because we all want to know about the new subsidiary in Congo. Maybe you can give us a bit of flavor on the Congo operations and the Congo startup and where Congo is now in terms of its strategic plans.
Yes, Congo, I think we started well, of course, in Congo, and we are happy with the current progress so far. Basically, we have not moved much fast in terms of lending side. We are still more deposit operations. We see quite a good growth on deposit and especially on Forex. And actually, it has been one of the channels supporting our subsidiary in Burundi because they have cup of dollars there. But also we have been able to integrate the payment system with the Central Bank Congo, because that was one of the outstanding elements which was delaying the team to move faster to other services. We have also deployed all the digital channels you see in Tanzania, the mobile banking, the internet banking, and the agency banking. That means we are moving with the same framework which we're operating here, and that will give us even age advantage in terms of our distribution channels. What we see, the market is still vibrant. There is quite some significant opportunities. We are currently in Lubumbashi, but we are about to open our branch in Kinshasa, and we should be able to open 2 branches, which is Kalemi and Bukavu. They're the area which has already been established to progress with the operations. The beauty of it, I think we have been able to lock in majority of the private sectors which are in Tanzania, but operating with the Congo, so creating ecosystem payments, and that has been one of the aids to support the acquisition of new customers and new business. So the potential of Congo is promising, and we believe we should be able to move strongly in Congo soon.
Just to update, the very positive development is we are still optimistic that we should see Congo break even in line with our plan. And that is in line with the numbers that we see as half year. We are strongly positive on the business growth trend, and we should see it breaking even within the planned timeline.
Thank you very much. I do take note of Burundi. I think it was mentioned that Burundi is now #1, and CRDB is actually #1 bank in Burundi. Is that correct?
Yeah, correct. According to the number which you have just issued.
Well, I think I should extend my congratulations to Bruce there. I think Bruce is sitting by the table. He must be taking a special pride on that one. Bruce, congratulations. I think the subsidiary that you grew has become #1.
Thank you. Thank you very much, Prof. And thank you to you too. You were also on the board. But I just wanted also to add for Congo, as MD was saying, why we see the process to be very high. I just arrived from Congo. We had a marathon Sunday there, the first marathon there. And we have, as MD said, for example, we've enabled, for example, cross-border transactions. As you see, 80% of the imports from that region are happening through the Dar es Salaam port. On daily basis, there are 700, 800 trucks going into Congo from Tanzania and coming out. So we've enabled our customers. They can now pay their taxes, clearing. So that's what MD was saying in terms of facilitating the transactions between Congo and Tanzania. Surely we expect to see more income coming out of that. But as CFO also said correctly, the losses they've achieved are far below what we projected. And that's why we are very optimistic that they will break even within the timeline planned. Thank you.
Thank you very much. I think Muammar had a few more questions. Muammar, karibu.
Thanks again, Prof. Yeah, I just had two more questions. The first one is on the current loan to deposit ratio. And if you look at the gross loans to deposit, it's roughly 97%. I just wanted to get management's view on, whether they're comfortable with that level. And if I recall correctly, I think the BOT has historically had a prescription to have it at around 80%. Is that still the case? And, have they kind of got in touch with you about current liquidity levels? I also asked this because a number of other banks in the system have equally high loan to deposit ratios. The second question is, and you just touched on this, is on your borrowings and your tier 2 funding. So is it correct to assume, as part of your effort to stabilize or improve your capital adequacy ratio, that you have some tier 2 funding or borrowings lined up? Thank you very much.
Thank you. I'll start with the first one and then the Tion CFO will cover. I think on LDR, basically the 97%, your question was whether are we happy with. We cannot say we're happy with, even though there is BOT removed those indicators as the key indicators. So it's no longer one of the indicators within the BOT measures. And nevertheless, that also speaks about how we compute the liquidity positions in the market. Because the current LDR CR97 is on the high side. And the effort we are putting forward, it's seeing going down. And that's the spirit we have, that it should go down from where it is today to the level of around 80-75 is where we are targeting as operations. Nevertheless, if we look on the positions which we had, our LDR stands at 82%, not 97%. And basically, in terms of aggregate, because that's what we measure, not on currency based. But nevertheless, 80 on our side, we consider that it's still on our side. With the effort we have put in place, we should see it going down. We are projecting, and we should be seeing that around 75, less than 80%. That's our ambition. Maybe CFO, you can cover on the issue of tier 2 capital.
Yeah, sorry, I was just trying to unmute myself. Yes, my question was, given where your current balance sheet liquidity is, and given also that your capital adequacy ratio buffer is kind of thin, do you expect to raise funds, tier 2 funds, to increase that capital adequacy ratio? Are you in discussions, let's say, for example, with any DFIs, to add some additional tier 2 capital? And if so, at what cost would you be doing that? I also ask this, like I said, because you have a very tight liquidity position, and unless you grow your deposit base, it seems you'll have to maybe tap into the international debt market to beef up your capital levels. Thanks.
Thank you for raising this. Overall, when you look at our tier 2 capital, we have a very limited headroom in terms of the regulatory requirement, because the maximum that qualifies to the tier 2 is not above 2% of the total risk-weighted asset. So you find, if you look at the risk-weighted asset, there is a limited amount which can qualify from the subordinated debt in terms of the tier 2 computation. So our strategy is more of the deposit mobilization. And as you realize, the 15% growth in deposit is a clear testimony, because it is ahead of the industry growth. And we believe with the current initiative we have put on ground, we are confident we should be able to see the deposit growth unfolding in the second half of the year, as we have highlighted in the outlook. But most important is we see we closed the quarter with limited government spending. The government is coming back to the payment of the supplier, and we should see liquidity improvement in the market, and that actually is giving more of the confidence on the sourcing fund from the local market. We continue to look at raising capital from the profit generation, because that's mainly where we would improve our capital compared to funding on the borrowing. As you see, our year-to-year growth in terms of profit, 53%, and the yield improvement actually confirms we should be able to grow our capital position in line with our business growth ambition.
Thank you very much, Fred. I think I also note the presence of Johan and Darren from 337 Frontier Capital. Johan, Darren, do you have any questions or comments? I think while Johan and Daryl decide on that one, I'd like to ask, hi, welcome.
Hey, Prof, thanks very much. I hope you can hear me. Sorry, I was just trying to unmute there.
Yes.
Yeah, so thanks very much. Congratulations, team, on the outstanding results. I don't have anything specific, but maybe just to follow up on some of those previous questions, our key concerns, and they've been highlighted already, but really, we are hearing reports that there are delays on repatriation of dollar dividends and portfolio flows into Tanzania. Can you just give us some color on that? How bad is the situation? When do you think it will be resolved? And then just two other smaller points, but the coverage ratio, I know you did talk about that. You said your target is to get to 70%. When do you think that will come through? Because it's a little bit concerning to see that coverage ratio drop so much in the second quarter. And then my final question, and it's related to that, these agriculture loans, I mean, if we go back, 5, 7, 10 years ago, it was the agriculture sector that really caused enormous amounts of strains on the credit quality and the loan book at CRDB. What gives you confidence that this time is different to then? What have you put in place to make sure that we don't go through that cycle again? And how much comfort, or what can you, to what extent can you give us comfort about, the control that you have on the quality of that book? And maybe if you can give us a little bit more granularity on what exactly is going wrong on those four agriculture NPLs that you mentioned. Thanks. But overall, yeah, very good set of results. Nice to see, and keep up the good work. Thanks very much.
Thank you very much, John. I think let me cover the question of agriculture. I think it has been one of the good debates, and basically because of the segment performance, but also for agri, that's why you see us not worried, because we know the reason behind. And for those customers within the agri segments are purely structured and financed when the contractual. The payment has just been delayed. It's not something which is where we have seen sector trading to the worst case. For the bigger customer we mentioned, I think is one of the big investors who is currently has a partner in terms of partnership, and they are just finalizing the contractual arrangement. By virtue of doing so, you should see it, that's customer getting out of the current positions. But because of regulations, we can't take him out of the status quo. It has to stay there until it is closed. The other agri customers are purely structured seasonal, which are seasonal input suppliers, and they have not been paid by the ministry. The commitment we have is for them to be paid toward this month, mid of this month, and next month. And that means you should see this customer getting out of the hook. Because agri financing arrangement we have currently is not similar to what we had before those times. This time is purely structured, and some are backed with LC arrangement, with master LC for all of them. So it has been performing well, and the majority of what we have financed for agri are also on the off-takers, where they have contract already with the buyers. And the arrangement of the facilities under SMA arrangement, quality management. So it's purely covered, purely controlled, and we should see it getting out of the current status. By virtue of that segment getting out, the coverage ratio, it will move away from where it is maybe to 50 to 60. And then we have another customers within the same group which is affecting our coverage ratio. It was a factory which was under constructions. And the grace period ended before construction finished. And because of that, it moved to the category which was not meant to be the category. But because of the regulations structure, we have to leave it there. The factory has just been commissioned, it's now operational. It should be able to perform as expected because the segment of the business is purely performing and there is high demand. So 3 customers, they will get out from the category they are in today. Our coverage ratio should be automatically back to 75%. And that is what we have been talking about. And that's why you see us confident on that. Why it has decreased is because of those reasons, because they move from the category specific. And maybe I just want to assure that we have not seen, as for now, agri portfolio being in problems, rather than is a matter of time and structure and payment expectations. Maybe you can cover the second one.
On the dividend repatriation on the dollar supply, we don't have any backlog in terms of the dividend payment related to the dollar. We are able to pay all the dividend as per the expectation. Yes, in the market, the dollar supply still a shortage, as we highlighted in the microeconomic environment, but we see a significant improvement with the support from the central bank. And we are optimistic that going forward, we see this position easing, and we are optimistic that we should see more improvement in this. But in terms of the backlog, not quite sure if you are referring to CRDB. We don't have any backlog related to the dividend payment.
Thank you very much. I think the question more was, I think some of maybe the foreign investors, when they're converting from their shillings to back to maybe remittable currency for them, they may be having some challenges. But the next question, I think there is a question from Brian Mugabe. He's asking about the market share of system assets. He was asking for confirmation whether CRDB's market share is at 27%. And also on the NIMs, the question was if this NIMs being high single digits is the new norm, or things can go back to a double digit 12% kind of NIMs that were there a few years ago.
I would talk about the market share. The market share is mainly driven by the asset base. We are the largest. Asset base in terms of the total asset, and that's our key strength. And you compare the same. We also have an advantage of the consolidation of the market from the regional presence. We are the only bank that has presence in the region. So we are proud of having that market share. And we believe we should be able to see that and more going forward. In terms of the NIM, The range of double digit is likely challenged by what we see in terms of the trend in the market. As we highlighted in the macroeconomic environment, the interest rates globally in the market, and as we continue to source some of the funds in Forex, you see some of the challenging in terms of the NIM. We continue to align our portfolio mix in terms of where we see the highest yield. Just important to note, when we are highlighting our strategy, we focus on the segments, the MSCs, SMEs, the women and the youth. But again, the growth that we are recording in terms of the consumer lending, these are the markets where we see the highest yield. But when you look at the consumer lending, again, highest yield, but low risk again. So that portfolio mix, again, gives us a biggest competitive advantage to continue driving our NIM in terms of where you could see it trending in line with what we have reported. I cannot confirm in terms of bringing it back to the 12 because of the market trend. But that leisure is being compensated by the strength on the growth on the non-funded income. And actually, the growth on the non-funded income will confirm actually the coverage of what we are losing in the on the NIM in terms of the outlook.
Thank you very much. I think that will give some flavor to Brian. I think Muammar has a follow-on question. Muammar, karibu.
Thanks, Prof. Thanks again, Prof. Sorry to repeat this, guys. I just had one more question on the agriculture exposure, and my question specifically on collateral quality. I know you mentioned that the collateral is, I think you mentioned that part of the collateral is the crops themselves. I just wanted to find out, is that the same case for all of the exposures that you mentioned? You know, is your current coverage net of that collateral crop cover? And then related to that is my second question. And this is, I mean, you're guiding on a 28% ROE for the end of the year. You know, anything could go wrong in the second half of the year. Is there anything that stops you from increasing your loan loss provision, specifically for the agriculture or your trade exposures, the kind of provisions that you can easily write back at the end of the year? I mean, is there any regulation that stops you from doing this? Thanks.
Okay. Thank you, Muammar. I would start with the last one. You note from our provisioning charge, we have accelerated our provisioning. And again, it's actually informed by the level of the write-off. But when you look at the quarter-on-quarter provision, you realize this quarter, there is an acceleration of the provisioning. And then we continue to provide, to accelerate the provision in line with what we see in our portfolio. Now back to our collateral strength. The collateral in agriculture is a combination. We have crops, but when you look at what we are referring to in terms of some of the customer that slipped into the NPL in agri, their strength is you have that portion of the crop, but we have a strong backup of collateral, which is the asset base. And then that is actually what is affecting the coverage ratio, because when you throw it through the model, realistically, you find the ECL doesn't come through. But as you rightly said, we continue monitor. Should we see any sign of necessitating the acceleration, we would accelerate the provision. At the moment, we see positive trend in terms of migrating it back to the normal, and therefore no need of accelerating the provision at the moment.
Maybe just to put some additional stuff. When you say crops, these are purely harvested crops and a CMO arrangement, which are also contractual. they have contract in place for the buyers. But the release of those collaterals is upon payments, and that's when you release those stocks for repatriations. So the stock we are talking about are purely covered, and it's actually 60% of the value of the stock is what can be given. But those stocks, they are contractual, they have buyers, and buyers are actually repatriating on phased approach. It's not that it's not covered or cropped on the farm, but purely these are contractual. And we talk about like of cotton, coffee, cashew nuts. These are commercial, and tobacco. They are commercial crops. And part of the securities, as CFO said, is the combinations. Well, these also farmers, they have strong asset base, which cover a portion of the facilities. But for transaction based, we do structure on the CMO arrangement covered by contract back.
Thank you very much. I think the agriculture has been well covered. I think the last question is Abdul Wahab. He has quite a straightforward question on how to go about what's efforts of CRDB to diversify the portfolio. And I think that will be our last question for this session.
I think I spoke about diversifications, and I highlighted that CRDB is moving much from corporate to retail. And SME, MSC is our key focus area, meaning the micro and mid SME size. We have done the same structure framework where the micro SME, we have digitized the process flow from the branch level up the approving level, but also the monitoring tools in terms of early warning signals to ensure that there is smooth operations, but also we are a bit flexible and agile without losing control in terms of quality of the portfolio. For MSME, we have also created a key of segments for branch level and head office level for risk management. And as I said before, we are using also our CRDB foundations as a training institutions to train our customers for this group, but to also focus on the women, which are bigger by definition, are micro customers. So the effort focus is pure on SME, and we are scaled down corporate. Corporate basically is on selective based approach with value chain framework attached. And once we have a corporate customers, we have to onboard all the suppliers through the SME framework and the value chain perspectives. These are our focus, but we have also defined some key solutions in terms of segmented based solutions for contractors, for suppliers, manufacturers. That will obviously differentiate us from the rest, how we offer SME. These are our focus area.
Just to add on that, notable is the growth that we are recording on SME MSCs, 45% on year to year. That's a very high growth in terms of the portfolio. Yes, in terms of the absolute amount, you'd still see it to be small because of where we are coming from. But that's the biggest growth, and that's where we focus in terms of our growth going forward.
Thank you very much. I think I'll say that this has been a fantastic conference call. I'd like to extend my thanks and iTrust's thanks to CRDB for agreeing to participate in the conference call and engage with investors. Thank you very much to the whole team, Abdulmajid, Fred, Anna, everybody else, Bruce, the team, Maji, everybody around the table. I'd like to extend our thanks. Thank you very much.
Thank you. We thank iTrust for answering this call, but also for bringing a lot of investors in the discussions. We appreciate for the conversation we have had with all the investors. The key question you have raised is key important questions for us to continue navigating, but also continue improving our operations. We see a positive market dynamics, and we are optimistic that we are going to be performing well as we move to this second half of the year and looking forward for third quarter results. Thank you very much.